Investing successfully in the stock market isn't just about picking great stocks, it's also about timing. A common strategy among seasoned investors is to buy growth stocks such as SCHG when the market is down and buy dividend stocks SCHD when the market is at all-time highs. This approach allows investors to take advantage of discounted high growth stocks during downturns and then shift to stable income generating dividend stocks when the market is booming. In this video, we'll explore why this strategy works and how to implement it, and how it can help you maximize your long-term returns. The Schwab US Large Cap Growth ETF focuses on high-growth companies that prioritize reinvesting earnings over paying dividends. These stocks tend to be more volatile, which soars in bull markets but also declines sharply during downturns. SCHG is very popular because of its high growth rate as well as a low expense ratio of only 0.04%. Some reasons you want to buy SCHG in a down market is because of its discounted price. Market downturns often cause even strong growth stocks to decline in value, creating attractive buying opportunities. The second reason is going to be future capital appreciation. Buying growth stocks at lower valuations allows investors to benefit when the market recovers. The third reason is the PE ratio compression. During bear markets, price to earnings ratios declines, making high growth companies more affordable. And if we take a look at the PE ratio of SCHD, as of January 31st, 2025, the PE ratio was at 38.51. And currently at close at March 2025, the PE ratio is sitting at $32. This means that you're getting this ETF at a nice discount if you do end up buying this ETF. Now, the fourth reason and why a lot of people buy this ETF is for tech and innovation play. Growth stocks, particularly in the technology sector, tend to drive long-term market exposure and expansion, which makes them ideal for a market recovery play. If we look at the top holdings, we can see we have very stable companies that are growing heavily in the tech sector, such as Apple, Microsoft, Nvidia, and Amazon. If we break it down by sectors, we are heavily in the information technology sector, sitting at 49%. These include stocks like Apple, Microsoft, Nvidia. We also have consumer discretionary, which is at 13.76%, which include stocks such as Amazon and Tesla. And then we have communication services sitting at 13.53%. So these are stocks such as T-Mobile, AT&T, and even Google. Our fourth biggest sector is going to be the healthcare sector at 8.73%, which includes United Healthcare and Eli Lilly. In the past 5 years, even with this decline, SCHD has seen a total return of 128% in the past 5 years. In the past month, we're down 12.55%, so it is a great time to buy during a market correction. The best time to buy growth-heavy ETFs such as SCHG is to buy SCHD during recessions, bear markets, and major market pullbacks. The best times historically were actually during the 2008 financial crisis and the March 2020 COVID crash. Next, we're going to be going over SCHD and why you actually want to buy SCHD when the markets are at all-time highs. SCHD is a US dividend equity ETF by Charles Schwab. The ticker symbol is SCHG, and it focuses on high-quality dividend-paying stocks with strong financials. When markets are at all-time highs, valuations for growth stocks can become stretched. Making dividend stocks a safer alternative. Some of the main reasons you want to buy SCHD in a high market is because of its steady income. SCHD offers a dividend yield between 3.5 and 4%, which provides a consistent cash flow every quarter, which is every 3 months. The second reason is going to be lower volatility. Dividend-paying companies tend to be more stable during market corrections. If we take a look at the past month, we are actually in the positive at 0.22% compared to SCHD, which is down almost 13%. And the third reason is the compounding effect. Reinvesting dividends in a strong market environment enhances total returns over time. The fourth reason is going to be risk reduction. As growth stocks become overvalued, shifting to defensive dividend stocks can help protect your gains. Now let's go over the top holdings in SCHD. We can see we have stocks in companies such as AbbVie, Amgen, Coca-Cola, Verizon Communications, Bristol Myers Squibb, Pfizer, Cisco, and Chevron. If we break down the ETF by sector, we can see financials makes up the majority of the ETF, and this includes companies such as JP Morgan Chase and BlackRock. Healthcare makes up the second largest portfolio percentage at 16.67%, and this includes companies such as United Healthcare, as well as CVS. Coming in at number 3, we have consumer staples at 14.37%, and this includes companies such as Coca-Cola and PepsiCo. And for the fourth largest sector, we have industrials at 13.28%, which includes companies such as Lockheed Martin as well as 3M. The best time to buy SCHD is when markets are at all-time highs and valuations are stretched. The best times historically to buy SCHD are during the 2017 to 2019 bull market, as well as late 2021 before the tech stock declines. If we compare SCHG and SCHG, we can see that SCHD has a higher total return, but we can also see it's also way more volatile, so you also want to buy this ETF when it is at low points. The best time to buy SCHG is during market downturns, and the best time to buy SCHD is to buy during market highs. The main benefit of growth ETFs, such as SCHG, is high capital appreciation. And the main benefit of SCHD is steady income and stability. SCHG, the growth ETF, is going to be very risky compared to SCHD, the dividend ETF, which is going to be moderate to low risk. And these risk levels are, of course, linked to volatility, where growth is going to have high volatility, and dividend ETFs are going to have low to moderate dividend volatility. And they are also diversified in their sectors. Growth ETF SCHD is going to have more technology and consumer discretionary stocks compared to dividend ETF, which is going to have more financials, industrials, and consumer staples. Now, the total return isn't always the full picture. If we see the past month, SCHD has significantly outperformed SCHG. So we do also have to keep in mind that both of these ETFs have its purpose depending on the market conditions. A well-balanced portfolio includes both SCHG and SCHD, but the allocation should shift depending on market conditions. For a bear market strategy, you want to buy more growth stocks at low valuations, so you want to buy more of SCHD when the market is down. On the contrary, during bull markets, you want to be heavily invested in SCHD and shift to dividend stocks for that stability. During flat markets, you can split your money into both half and half SCHD and SCHD, which is going to give you both growth and dividend exposure. This strategy ensures investors capture growth opportunities while also protecting their portfolio from excessive volatility. Choosing between SCHG and SCHD isn't just about preference, it's also about market timing. You want to buy the growth when markets are down to benefit from discounted high growth stocks, and you want to buy the dividends when markets are at all-time highs to lock in the steady income and reduce your risk exposure. By aligning ETF selection with market cycles, investors can maximize returns while managing risk effectively. Whether you're a long-term investor or an active trader, understanding market trends and adjusting your portfolio accordingly will lead to better financial decisions.